as Phil said, this is a presentation I've done for some of the Sterling clients 3 times last October, so just an update of that. As usual, there's a general advice warning, so this is not specific to your needs, and please see a financial advisor for more information. So the point of what we're trying to do at Investment Science is generate higher returns for the given level of risk taken, and the way we've done that with the design, which was basically a blank piece of paper, which I had when I was, or which I started, I should say, when I was previously employed at Funds SA, the big South Australian government super scheme. So I never exactly expected to see this strategy to see the light of the day in a big government institution, but the idea was as a mental exercise, if anything, to come up with something which would be able to come up with, using a blank piece of paper, come up with an approach which would maximise returns for a given level of risk. So what we decided was that the key starting point was to start with an alpha first approach, and we call this approach strategic risk allocation, or that the volatility target is the SRA. The main comparison between strategic risk allocation and the main approach to multi-asset class, multi-manager investing is strategic asset allocation. And we claim that strategic asset allocation has constraints to performance. So we've decided to remove as many constraints as we can, and thus allow greater diversification and therefore greater return per unit of risk. I'll then talk about specifically the products, SRA 4 and 9, and how we use that alpha first approach. And then last, I will talk about our SRA 16 product, which is a hedge fund in the global tactical, or with a similar instrument universe to some of the commodity trading advisors such as OMIP, Winton, and Man AHL that are quite popular. So just at a conceptual level, this is a similar topic to what Simon dealt with in the last few weeks. So at some points I'll go through it very fast, but there are others which help to build up the mathematics behind one of the key points that that Simon was talking about. So one of those things that I was pondering back when I was at Funds SA is why there are institutional barriers to adding value after fees, and the main blame that I lay is at the traditional approach is a beta first approach, whereby the first port of call as to how you construct your portfolio is an asset class based restrictions, and so that inhibits the construction of better diversified portfolios. Market cap weighted investing, so typically these asset classes are based on market cap indexes, and the traditional approach is to manage each piece of the portfolio in accordance with the most widely diversified market cap weighted index. The problem with that, and it's the basis of a quite popular approach called fundamental indexing, is that that approach points out that the market cap weighted approach makes you tend to buy securities at the top of their price range and to sell them at the bottom of their price range. So it's the opposite of what you should be trying to do. Another problem is that defensive asset classes subtract value versus simple cash strategies. So if we'll consider the 30% that most growth funds have in fixed interest, the traditional style fixed interest is government bonds with a little bit of corporate bonds, and from a risk premium point of view, the typical fixed interest asset class has about 0.5% per annum excess return over a long period of time over that of the equivalent risk-free rate. So that extra 0.5% for investing in that 30% of a portion of a growth fund is actually subtracting value once you subtract off all the fees that are embedded in the vehicles and fee structures that your clients will be investing. So the point is that clients are better off to have invested in term deposits outside financial advice structures than doing it this way. Another main problem is that equities funds, so typically those funds which are benchmarked to those broad cap indices, there's been a lot of surveys, I'm sure you've heard this before, that they tend to subtract value versus a simple index strategy. And they can't capture the sufficient outperformance to cover the fee difference, the number of fees that apply, such as I mentioned before. One of the key points we make is that the diversification of the traditional balanced portfolio might look reasonable, but this is on the basis of total allocation, so percent exposure. But what we do, the way we think of it, isn't so much the amount you've allocated to it, but the damage that it can do to your portfolio. So we do a calculation whereby, just this formula at the bottom of the page, the risk equals the allocation, which we saw before, which was I think 40% for Australian equities, times by the standard deviation. So in the case of global equities, we have 4% risk, and the way we get that is 25% allocation in this portfolio times by long-term standard deviation of this asset class of 16%. So a way of redrawing that same pie chart is, instead of just using the allocations and adding them up to 100, you're using this risk allocation, and you end up with a number which is not 100. I'll come to that number later on in a later chart, but it's for Aussie equities it's 6.3%, for global equities it's 4%, for listed property 1.4%. And now the good thing about representing it in this way is that you're now starting to put the strategies pieces in the pie. First of all, deal with fixed interest. So fixed interest was previously, I think, a 10 or 15% allocation of the pie, but from a risk point of view, it's actually very small. So by tying up 10 to 15% of your portfolio in a low returning, low alpha asset class, you're not really adding much in terms of diversification benefit or added value. We're now putting in, and this is a fairly typical approach, reasonably active management, 0.5% risk from tactical asset allocation probably equates to something like a plus or minus 5 or plus or minus 10 tactical bands for allocations to equities. The Australian equities managers, here we've got 5, roughly allocating 8% to each. A bunch of international equities managers, which have roughly got about, say, 5% allocation to each, with about a 5% risk budget, so that's 0.25%. So 0.25 for each of these bands. Bearing in mind, of course, that you've got Australian equities 6.3%, global equities 4%, and listed property 1.4%, and all these are very highly correlated with each other. And then you have your property managers and fixed interest managers, which have a tiny sliver, you can barely see it. So the size of the pie, in this case, is 15.5% when you add all these up. But because this has these elements have diversification in them, you have a total volatility roughly for your typical growth 70-30 fund of 9% per annum. So your diversification benefit is 6.5% per annum. So the thought that we had was to say, well, it seems that the best diversification you get is by amping up your allocation to the manager strategies. And so that's what we've done. This is a stylized representation of the SRA 9 portfolio. It will change periodically depending on the changes to managers. The managers come in and out. But this is essentially what we're trying to achieve. We're trying to achieve much lower allocation to the equities risks. So here we've got only 1.1%. We're now using small caps to a much larger extent. We're now using emerging markets to a much larger extent. We're choosing, in this case, global infrastructure, but we could choose particular equity sectors that we have favoured at given points in time. We could potentially have a larger allocation to some of the bonds in the portfolio if we were able to leverage. We can have allocations to gold and other commodities that we like from time to time. The tactical asset allocation we show here is plus or minus 25% with regards to equities, which has been used over time. And then we've got a much wider range of managers which are contributing to roughly half the volatility of the portfolio. So here we've got a total size of the pie of 27.5%. Previously it was only 16%. But because we're using more diversified pieces, it's the total volatility is only 9%. So the diversification benefit that we pick up is 18.5. So all of the elements of this portfolio, all the elements of this pie, are seeking to add return. So it stands to reason that the portfolio which has a larger pie can expect to have a larger return. And that's the calculations behind this chart, which is in a brochure that we've produced, and it was the topic of the one of the segments that Simon spoke about last week. So we're just representing the same pie charts that we had on the previous pages, in this case in terms of bar charts, and aggregating some of the pieces into a simpler colour scheme. So the typical fund, index 70-30 fund, in terms of risk, so in terms of volatility, has about 10% of its risk in the equities-based asset classes, and a little bit more, about 1% or 1.5% in the fixed interest or defensive asset classes. So going over to so that's on a undiversified basis. When we look at the size of the pie, when we had a reasonable attempt at active management, we've now got some of the manager strategies adding up. It's this light green piece of the column here, and some degree of tactical asset allocation is the grey piece. That's a reasonable attempt. That gives you around about 16% volatility in total. And when we do that with the SRA 9 version, we've got much higher tracking errors of our managers, much higher risks, and much higher risks with regards to the tactical asset allocation. So these same bars are translated but with a different colour scheme on this side, which is where you subtract off the diversification benefit. So the diversification, the greater diversification within the portfolio of the SRA 9 means that you're starting with about, in this case, 23%, and you end up with 9%. So all these portfolios end up with total portfolio volatility of 9%, but this one has 23% to start with. And the reduction is, so SRA 9 has 23% to start with, and the reduction is due to the greater diversification in the portfolios. When it comes to translating risk into return, everybody knows that there's a roughly proportional relationship between that. So we consider, and we'll deal with this later, the concept of total value add. So we don't think that the first 5%, being the cash return, is any great claim to fame of any of these portfolio approaches, because anyone who didn't want to take any risk and didn't want to take any liquidity issues could just invest in a online bank account and have their money basically at call. So it's really the increment, or in this case the risk premium, above 5, which we think is roughly about 3% for a 70-30 fund. That's really what you're picking up for taking on the volatility in an index fund of 9%. A reasonable active approach, it gets basically the same return from the asset classes, but because you've taken on this extra risk with regards to choosing managers, if you've done a reasonable approach with choosing managers, done a reasonable approach with some tactical calls, we think the evidence suggests that you can make about 1%. And when I say the evidence, we have looked at a survey going back about 9 years of 6 of the popular implementer consultants, Mercer, Russell, John A. Nolan, IPAC, Intech, and MLC. And over, I think it was 9 years, maybe it was only about 8, but over that period of time, the best of those managers added value of 1% per annum from manager strategies before fees, before all fees. So this 1% really does seem to be an upper limit with regards to your best efforts, best resourced efforts from choosing managers in the traditional asset classes in the traditional way. For the SRA 9 portfolio, with its much higher allocation to manager strategies and much higher allocation to tactical, it is reasonable to expect that with that higher degree of risk that we're taking on in this leftmost chart, we get a higher amount of return. And so it is proved, which I'll take you through later, and that would make sense from a theoretical point of view. So here we're showing you the theory as to why we expect to massively outperform our peers, and in a few slides time I'll take you through the historical evidence to back that up. So what we've been talking about was the concepts. We now delve into specifically how investment science try to add value. So from our multi-asset class multi-manager products are the SRA 4 and SRA 9 portfolios. They've been going since November 2007 in the case of our Access SRA fund portfolios, and about 1 year in the case of the Alliance Fund and Sterling Fund. So the point that we start with is just a total risk approach, a total risk target for the product, which we consider to be risk equivalent, 4% for the SRA 4 and 9% for the SRA 9. The numbers in the name, so we consider that naming scheme to be more relevant with regards to the damage that the portfolio can do to your wealth, rather than seemingly arbitrary but reasonably well-known industry names such as Capital Stable and Growth. So the 4 is equivalent to a Capital Stable fund, and the 9 is equivalent to a growth fund with 25% growth assets and 75% growth assets respectively. The way that's comprised is investments in 15 to 25 funds. We have an internal fund, the SRA 16, which is where we concentrate our tactical calls, and that's set with a target of 10% in the case of the SRA 4 and 15% in the case of the SRA 9. We expect to have some degree of cash holdings in the SRA 4 and SRA 9, and that's mainly to cover the margin required for futures brokers with respect to the derivative hedging contracts that we have in these portfolios. I'll talk about that a bit more later. The fees are a flat 1.28% per annum. That doesn't include the underlying manager's fees. When we report the return, as you'll see later, we will take out those fees, and we always report returns net of all fees. The expected return, we consider the ultimate objective of any investment where you take on risk is to beat the return of cash. So for the SRA 4, after fees, we expect cash plus 2.8% per annum, and for the SRA 9, after fees, we expect cash plus 5.8% per annum. The main difference between the 4 and 9 is that the 4 is benchmarked to be equities market neutral, and the 9 is benchmarked to have about a 50% exposure to equities markets, or effective exposure, over a long period of time. So a lot of the difference in the expected return relates to the higher allocation to equities and the equity risk premium. But there's an extra, and that comes through effectively in the index return. So we expect 2.3% return over the risk equivalent index fund, and we expect 2.8% per annum over the risk equivalent index fund. So we expect to outperform peers by that amount, assuming peers can match their indices after fees, which they can't. Applications and redemptions, at the moment it's monthly. On the last business day of the month, we have a project in place to move that to weekly, similarly for redemptions. Currently monthly with 8 business days notice, and weekly probably with about 5 business days notice. And that will probably take about 2, possibly 3 months before we have the new PDS and those administration arrangements in place. So I just want to draw attention now to one of the key differences with regards to our approach versus the traditional strategic asset allocation approach. I mentioned before the traditional strategic asset allocation approach is beta first. So just briefly take you through that. I'm sure you're familiar with it, but just to remind you of what it is and how we differ. So beta first to us means that you determine the risk and return of different asset classes. So you've defined the asset classes, you've got expected risks and returns, create an efficient frontier of optimal portfolios, and then the particular investor chooses the optimal portfolio on the risk-return frontier. And then once that's all done, then it's up to the product provider in one form or other to choose the managers to manage an allocation to each asset class. So we feel like you're very restricted in that regard, because a lot of strategic asset allocations have a relatively small amount allocated to alternatives, whereas we found that some of the alternatives have the best alphas, have the best degree of outperformance. So remember that the diversification, the best diversification is the strategies diversification. So we don't want to be restricted only to those strategies which are listed in a arbitrary strategic asset allocation, which was set with regards to some peer comparisons and some optimization which was done many years ago. We want to get the highest amount of diversification and the highest return for the given level of risk. So what we're interested in most is just managers which can outperform benchmarks, really any benchmark. We look for investments with the right characteristics. We'll take you through that in a few slides' time. We explicitly estimate the components of value add over each, and we bias the selection to the products with the highest net value add over benchmark. Once we've done that, we can add up the beta exposures, and a key insight into how we deal with risk, particularly with equities risk, is that, look, it's no surprise to us that things like high yield bonds had high correlations with equities during the global financial crisis. They typically had that, quite often over various periods of time, and we have a portfolio construction methodology which adds up all of the exposures to equities, no matter where it's no matter where it arises in the portfolio. So we don't have something which is highly correlated to equities hidden in something called fixed interest. We don't have something lowly correlated to equities which is put into alternatives, which is then also counted as a growth fund, which means that you're understating your risk, and perhaps you could have higher returns if you had more risk. So once we've added up those exposures, we then, in our products, allow ourselves to use derivatives to hedge out risk exposures. We define that in very general terms, but this is analogous to what a lot of equities managers do, or international equities managers do, with their foreign currency exposures. So we say, well, let's not just think of it in terms of foreign currency exposures, let's think of it in terms of equities exposures, let's think of it in terms of commodity exposures that might arise from our investments in, say, a global resources fund. So the first thing we do is choose the managers. So here's the list of the managers as at 31 December 2010. And as you can see at this point, we're not grouping them in any particular way. Actually, we are by the colour scheme, but the point is that we're mostly agnostic at this point as to what these managers have invested in. We're most interested in their strategies, that these strategies are diversified with respect to each other, and that their strategy makes sense. So the right characteristics that we're looking for are both high conviction, skill, and advantage. So on this chart we've got three components, and we've got again, it's a bit of a stylized representation of the types of asset classes and opportunities we're looking for. The first part, which is labelled skill. Now this relates to our skill, and the point being that if we were to choose the best manager, the very best manager in something like Australian listed property, typically you're probably only outperforming by about 2.5% for the very best manager. And if you were to choose a manager that's only a little bit better than average, you probably only get an outperformance advantage of only about 0.5, 0.6%. Whereas for the same extent of outperformance of choosing the manager which is only a little bit better than average, you get a higher payoff from those managers where they have high conviction. So we consider global tactical asset allocation is the group of strategies or manager universe which has the highest conviction. So a lot of these strategies have 16% tracking errors. So in a good year they could make in the 30% and the 40%, such as we saw with our own fund in the global financial crisis, because we got our calls right with a target volatility of 16%. So some of these other strategies in here have high payoffs, simply because they take higher or larger positions whenever they have an allocation. The second part of this, which we've labelled advantage, it's a concept that we've I think I've only ever met one other person who's described it in similar terms to what we describe it. But the point is, for us as you could probably say reasonably low-resourced fund pickers, we would rather have a fund where we can have a great confidence in the concept of what we're investing in rather than in the skill of the manager. What that means is a manager like Russell, sorry, a fund picker like Russell would be able to line up, say, 20 international equities managers or 20 Aussie equities managers or 50 international equities managers, and spend hours upon hours with them over many years and try to get some insights over as to which are the most skilled managers and which are the least skilled, and have an opinion of that independent of the actual returns. Whereas for us, we need to be able to make quicker decisions, so we tend to have a focus on what we call advantage, which is a concept whereby we have identified what it is that the manager is trying to do. So often it can be a really simple idea that the manager is pursuing, or it could be an advantage that the manager has over most of the other players in the market by virtue of their size. Could be large size or it could be small size. An example I've got is a Credit Suisse insurance-linked fund, which is currently in the portfolio. So Credit Suisse, this team look after a portfolio of around about $3 billion US, and that puts them in the league of directly dealing with reinsurers, the global reinsurers, Swiss Re, Munich Re, Berkshire Hathaway, and that's a market that's available to them because they deal in such large size that's not available to some of the hedge funds that deal in insurance-linked strategies, where they're only managing 50 or 100 or $200 or $300 million. An example of where low funds under management is good is our investment in the Macquarie Special Events Fund. They're corporate events in Australia which fly under the radar of some of the larger international players in the space, and so they often find that there are some of the resource type takeovers and mergers going on in the domestic market which are too small for some of these other funds to take a position in. The third element of that was fees. I guess that's pretty obvious. So what we've done in this chart is the same as the previous chart, but here we've subtracted the fees. And here we've drawn in a wavy line representing the typical fee hurdle for retail investors. So what we found, and we've circled it here, highlighted here, the strategic asset allocation approach biases your strategies to those asset classes whereby we've identified that the net value add opportunities are the lowest or negative even. That's even before taking into account all the other fees that we add on, that the custodian adds on, the platform adds on, and the financial advisor adds on. So we've drawn here just a simple colour scheme, green for go. These are the opportunities that we're interested in, where we've got high potential value add and high expected value add. These orange ones are the ones whereby if we find a great manager that we've got great conviction in, then we'll consider investing in these. And from a manager research, product research point of view, these are the types of investments and manager universes that we will just ignore. So that was at the conceptual level as to what types of investment products we look for. When it comes down to sitting in front of a manager and going through their presentations and talking to their staff, this is what we look for. So to the extent that we look at returns, we obviously try to avoid those with poor returns, but we make some allowance for their known style and consequently the returns of managers with those styles. It is forgivable for a manager to have poor performance if you can acknowledge that with that particular style over that period, that would have been unfavourable. We look for managers which have some sophistication with regards to their attribution of returns. It's probably an indicator of, the better the attribution is, the more the manager is navel-gazing at their own returns and understanding the drivers of their returns, what they've done, where they've made mistakes, and feeding that back into what they do in the future and how they modify their process. We don't like performance fees that give a freebie to the manager when the market outperforms. The classic example of that was I was talking to some Asian managers in 2007, just about the market peak, and one of them showed a return of 28% versus the benchmark return of 35%. And we said to them, so why did you underperform over 3 years? And they said, oh, well, that was because of fees. We take 20% cut of the benchmark return of 35%, and to us that's just obviously it's a free kick to the manager, and it's less return on the table for the investor. Another fairly obvious one where managers are near capacity. There's a few ways you can assess that, but it's in some cases a bit of a rule of thumb. Where there's instability amongst staff, we probably think managers can be sin-binned for maybe a year if there's some instability amongst some junior staff, or one or two out of the key team of 4 or 5 leave, and that's probably more of a case of seeing that more key staff don't walk away, and if things settle down after say a year, or sorry, if there's no further changes after about a year, and those promoted into the seats seem to be doing okay, then we'll potentially invest. We avoid cynical business practices. It's a case of you know it when you see it, but probably the typical one is where a fund manager would open up funds, start funds which have elements of what the latest fad is, and seem to be fairly quick to close down funds that underperform. The types of products that we particularly like is where there's evidence of alignment of interests with investors. It's a bit hard to exactly say what that is sometimes, but often it means it's a boutique manager. Often it means that you see a bit of I should say, a bit of excitement, just the passion of the management team. In some ways, the less slick they are with regards to their marketing is probably more of an indication that their efforts and their thoughts are going into portfolio management. We make an assessment of the inefficiency of the market in which they're playing, and that could also be that they're active in a specialty space in an efficient market. A great example of that would be one of our funds that we've held for about 3.5 years, almost since inception, the DWS Global Equity Agribusiness Fund. So we consider that international equities are reasonably efficient, particularly large caps, but this fund has a concept whereby they cut across what would typically be the way analysts are specialised in normal investment houses and normal investment banks, and that is that they have a theme-based approach to looking at agribusiness ideas, as the theme being that they will look for those companies that are best positioned to service the challenges of the looming, put it bluntly, the looming food crisis. We look for liquid markets. This is more of a requirement of the product that we're managing at this point. As we said, it's going to weekly unit pricing, so We have explicit limits in our investment guidelines on the degree of liquidity that we need to hold with regard to cash and with regard to daily unit priced funds. And we can't have funds which are, sorry, we don't have funds which are quarterly priced. One of the key things that we're looking for is some evidence of thought leadership. So sometimes this are things that aren't directly related to the portfolio management of the product that we're considering, but it's just an indicator of things that you want to believe that the guys that are managing your money are smart, that they're having insights that are unusual and unique and are likely to add value over time. We look for a consistency of message through time. The point is, we don't like managers who flip-flop with regards to what they're trying to achieve in a particular product. We think that, look, I'm a statistician by training, and the time frame over which ideas can work would pretty much confound anyone who's got a less than a 3-year time frame over which to measure the statistical statistical validity of any given approach. So we actually think that if we want to see the manager have a clear and strong idea as to why they are aiming to outperform, and to stick with it over a long period of time. And the last concept that we're looking for is advantage, which I defined before. So it's something whereby any competent manager that has that idea would be able to follow that idea and outperform the benchmark. On this slide, I show how the manager strategies have varied over time since inception. A couple of points to note about this is that, first of all, these charts look roughly the same. So we've got a low volatility, basically capital stable fund risk equivalent for the SRA 4, and a high volatility, basically a growth risk equivalent for the SRA 9, but that the allocation to the manager strategies is basically the same. So it seems to us somewhat illogical for the traditional strategic asset allocation approach to have 75% in equity strategies in the case of, say, a growth fund, and only 25% in the fixed interest strategies, and then flip those proportions around in the case of the capital stable fund. Whereas we have our best ideas, the highest alphas, diversified, meeting liquidity, etc. And it's roughly the same in the case of both portfolios. What I've drawn here with the black line, making a highlight of the black line, is what we would call, or what we think most people would call, hedge fund strategies. So we've been asked many times, are these hedge funds or funds? And we go, well, we have hedge funds in there, but look at a lot of the super funds in Australia now, and they have some allocation to hedge funds. And our question is, well, if you're able to have 5 or 10 or 15, why not 50? And that's been our approach to it. So the reason why you would not have 50 is the reason why some of the managers that had hedge funds in there, or hedge funds or funds in there, got caught during the global financial crisis. And that is that you're investing offshore, you're investing in markets, so not markets, regulatory regimes which aren't as strong as Australia. You're investing in things which maybe are more illiquid than what you're expecting. You're investing in things which can potentially have lockups which are longer than what would be normally rational for a orderly sale of the investments in the fund. So all those things, all those elements of loss of control are reasons why super funds haven't invested much more than they did in hedge funds, whereas our approach has been to invest directly into hedge funds. So what you're seeing here is our direct investments into Australian registered managed investment schemes. There's a couple of exceptions whereby they're onshore managers, where the manager is, or it's a wholesale scheme basically. So the manager is licensed by ASIC, and the assets are held onshore. There's now a couple of exceptions, one being Credit Suisse, and the other one being FRM, where both are massive blue chip international managers. We're investing in the Australian Registered Managed Investment Scheme, investing into a offshore feeder fund. And we've done appropriate due diligence and operational due diligence on those funds. So the allocation to hedge funds has been between about 40 to 60%. The allocation to typically long-only equities managers is the remainder of the colours, roughly about 50 to 30% over time. And this white space is shown as cash. So there is actually a difference between the 4 and the 9 with regards to the holdings of cash. I mentioned that before. So that's how it's been. I'll move on to the next slide. So the next stage in the portfolio construction is add up those exposures. So this is actually an old portfolio, but it just represents how we add up the exposures into different allocation buckets. And one of the points is that some of these funds have higher allocations to equities than others, or higher effective allocations to equities than others. I gave the example before about high yield being no surprise to us that had some equities exposure to it. Now we would think that most high yield funds, sorry, I don't have to say that the typical high yield indices have around about a 0.4%. It's like having a 0.4 times that exposure to the equities market. And things like small caps have a higher volatility to the equities market. So we consider that has about a 1.3 times exposure to the equities market. And similarly for similarly for emerging markets, we consider that to have a 1.4 times exposure to equities markets. So we add up all those exposures to equities markets on the bottom line here, and we add up those exposures to FX. And the last step is to use a basket of futures hedges. So here's the basket of equities hedges down here, and then currency hedges here. And in future we'll be able to utilize a greater array of currencies via a arrangement with a futures broker where we can deal over the counter. So the numbers of currencies we can deal with will go from the current list of 7 to around about 20. So things like Brazilian real, Hong Kong dollar, Singapore dollar, Chilean peso, and some of the Eastern European currencies, the Danish kroner, Norwegian kroner, etc., will be able to be hedged. With regards to equities, we calculate how much we have left over with regards to exposure. So here, this is the SRA 4, which is benchmarked to have a 0% net equities exposure on average. But here we're clearly bearish. We've got minus 1.4% exposure to Australian equities and minus 2% exposure to international. The way we use tactical asset allocation. Look, from the point of view of what investment products we invest in, we aim for diversification without diversification. What that means is that we're not driven by diversifying by asset classes to achieve diversification, but we particularly want to avoid investing in those asset classes which we think are unfavourable. An example would be in April 2008 we had one investment in Australian small caps manager, and with the forced closure of the books of Opus Prime, Tricom and Lift Capital, we were very concerned that the Australian small caps market was going to be severely impacted by the forced liquidation of those books relative to the Australian large cap market. So that was an example where we took a view on the small caps and decided to exit. Currently, right now, we think sovereign bonds are a very bad deal, and so we would not be holding any sovereign bonds. That being said, if we have a neutral view on a asset class, we'd be prepared to hold an investment in it if we expect that the manager outperformance is going to be very high. So we consider there to be two types of investment products, hedgeable beta and tag-along beta. What we mean by hedgeable beta is where there's a readily identifiable derivative instrument for us to hedge, which hedges out most of the benchmark risk of that investment product, such as Australian equities and currency hedged Asia ex-Japan. Tag-along beta, there's no futures markets which have high yield indices as a readily tradable derivative contract, and similarly for the basis risk of small caps versus large caps. So to the extent that we invest in, and other ones would be specialist sector funds in equities markets, such as if we liked global listed property from time to time, or we've liked global listed infrastructure pretty much since inception. That's a call on the sector. The discretionary strategies team assess the outlook for equities markets, and they score the prospects between -4 being maximum bearish and +4 being maximum bullish. And that maps onto an effective equities beta between 20 to 70%. So here's how that's looked over time. So with regards to the SRA 9 portfolio, the light purple area is what we call the gross equities exposure. That was step 1 that we saw before. Step 3 that we saw before was, sorry, it was really step 2 when we add up the gross equities exposure. Step 3 that we saw before was the equities hedges. So we subtract the grey from the purple and end up with the blue line. So we're managing the equities beta by, and we can manage that very quickly. We can change our positions literally within half an hour of the discretionary strategies team changing their calls, and so we can do that very quickly and very cheaply as well. An interesting point to note here, which goes to show the flexibility of this approach. This was a point where we were transitioning between some equities managers. We'd sacked some and were appointing some new ones, and so we had money out of the market. We'd redeemed from those funds, so the gross equities beta fell from that point to that point. But at that point, we're still looking to maintain an increasing exposure to the equities market, and we're able to do that by having, by actually going long the futures contracts and having the cash to back those. So that's an added flexibility that we have in our portfolio, which means, which is not typical for financial planners in the way that they deal with funds and for other funds which don't use futures. The SRA 4 portfolio, you can see that that's been managed to a net equities beta that's been fairly tight around 0 over time. So pretty much to the extent that we have equities managers and equities exposure in the portfolio, we've been seeking to neutralize that with the futures hedges. On this, I've drawn the targets that we have. The SRA 9, the targets have changed from time to time. We expect the portfolio to have a 50% effective net equities beta on average over a long period of time. And our problem was that the discretionary strategies team were being particularly bearish and persistently bearish at the maximum level for around about 50% of the time. So about this time last year, we reduced the lower end of the range, which effectively meant that they would have been aiming at 20% net equities beta, and instead they were aiming at net 30% net equities beta. They still maintained a very bearish position until about November last year, and now we've gone back to neutral. So a fairly recent change just about a month ago is that we've decided to increase the midpoint of that range. So now the net equities beta is about 55%. So that over time we're still going to be aiming it at 50%, and we're still going to be aiming the volatility of the portfolio at 9%, most of that volatility being comprised from equities returns. So we've noticed that there's a larger amount of peer relative risk in the SRA 9 versus what we had envisaged over time, we aim the SRA, we still want 50% equities beta versus its peers of 70, and the fact that we've held it at 50% underweight and 40% underweight versus peers for a long time has induced a much larger peer risk in the portfolio than what we expect, and we've corrected that with these latest changes. The net equities beta of the SRA4, this is the Access SRA4. The Alliance SRA4 has had some greater divergences from zero simply because the portfolio has been very small since inception, and so the hedges have been much less precise over time, much less precisely targeted at zero. The SRA4 return has been, so this is to 31 March 2011. We've just put in, just in the last few minutes, the return to April, 1.04%, estimated return. So we've got about 60% of the managers having given us a return or an estimated return, and that's not official yet. We post those estimated returns to our website, and we provide a link to that. We can provide that later. So by this time of the month, you will have a pretty good estimate as to what the returns have been. For the SRA4, we're targeting 4% volatility, so this is probably the starting point, 4% volatility since inception. Sorry, 4.38 since inception relates to the 4% target, which isn't too bad. The since inception return, 6.8% versus what we consider to be the cash benchmark of 4.93, so the true net value add has been 1.87. That's been comprised of manager strategies, so the managers have outperformed by 2.44% on average across all the managers in the portfolio. The tactical asset allocation has added 0.55%, and these are the fees that we in the Access SRA fund and the Alliance fund. So we're not sure where those fees should be allocated against, but in the end it's subtracted before we get to the net value add. So any criticism that the fees are too high in this product should only be relevant to the extent that these fees here shown in this line are so great that they subtract too much from manager strategies and tactical so that the net value add is zero. That hasn't been the case since inception, and it certainly hasn't been the case over the last year, which has seen a very strong return. Remember, we expect cash plus 2.8% per annum is our long-term expected return. Over the journey, the manager strategies has been very consistently strongly performing, with probably two exceptions. One was the height of the global financial crisis, where we had a cumulative 2% value add from managers and went from +2 to about -2.5, and since then has recovered to be cumulative 8%. So we consider that to be very high value add, particularly before, as I said, about the cumulative value add of the Mercer and Russell, those 6 managers in the Implementer Consulting Survey only added 1% per annum over 8 years. That's before all fees. Tactical asset allocation, or the tactical calls, were excellent during the global financial crisis. Faded a little bit in the 6 months when equity markets bounced very strongly, and has been about flat since then, for total cumulative value add of around about 7% after fees. This is the value add versus cash, so just the same line as what we saw before, and the total value add being around about 7%. So the cumulative return of the portfolio is around about 25%, but you would have got 17% if you just invested in cash. So we're only claiming value add of that last little bit. It's been growing steadily since the end of the global financial crisis. The same analysis for the SRA9, but this is better. Starting with the volatility, which this number should be 9%, so to the extent you can criticise us for having a lower than target volatility, the only way we could have got that up is if we'd had higher allocations at the wrong point in time to equities markets. This is the highest returning fund, highest returning multi-asset class fund since inception, or 7.7%. And it's the highest returning. Look, in the last monthly webinar presentation, we did an analysis which showed that this is the highest returning multi-asset class fund in Australia over the market cycle. So taking out the fact that we were bearish and correct during the global financial crisis, the SRA 9 is still the highest performing fund even with that bias taken out. But including the global financial crisis, this is a long way ahead of peers. Similar story for the cumulative value add components, but noting that the tactical asset allocation contributed an enormous amount of outperformance during the global financial crisis and gave away some of that in the next 6 months when equity markets rallied hard, and given away another little bit of that in the last year. But again, the value add from manager strategies, excluding a little bit of negative returns during the global financial crisis, has been very solid and is now about 12%. So extremely high versus that which we've observed from peers. And similar story for the total value add net of fees. The last point I'll talk about on the SRA 4 and 9 products is that there are constraints. This might seem like the Wild West of investment management, that we can invest in whatever we like. That's true enough. The point is we want to keep it flexible, but there are some guidelines that we have which are essential that we are seen to be keeping within sensible investment parameters. And those are prescribed in the investment management agreement between the responsible entity and the SRA Alliance Trusts. The responsible entity should sue us if we breach those guidelines and if we cause losses to the fund as a result. Those constraints cover those investments which are allowable, disallowable, limits on concentration, limits on leverage and net equities exposure, and limits on liquidity. We can provide these to you in detail if you want it later. So the summary of what we're trying to do in the 4 and 9 is that we're trying to achieve better diversification. We consider diversification to be the investor's free lunch, and with the set of rules that we have, we're much better able to achieve this than via a strategic asset allocation mandate. So what we have versus a strategic asset allocation manager is we measure far more market risk exposures. So we look at sectors, we look at countries, we look at economic outcomes, we look at bonds, we look at commodities, rather than just having a broad market index classified as international or Australian or small caps. We use hedges, we use futures hedges for equities risk exposures, interest rate risk exposures, potentially FX risk exposures, and commodities risk exposures. We're able to invest in a wider range of investment products, and we have a mandate to be opportunistic. The lag between seeing an opportunity and investing in it is much shorter with our setup than with a super fund, which has to go through consultants and trustees, and we think it's quicker than most financial planning approaches, except perhaps MDA type approaches. The main differences you'll see in portfolio construction is we have less equities, as I said before, so basically 20 to 25% less equities as a core exposure, and we have less bonds. So we don't have that 30% sitting in the growth fund in bonds. And so essentially we have about 50% of the portfolio in return-seeking alternatives. And that's the end of the SRA 4 and 9. I just thought at this point, considering I've gone over time, should I pause now, Phil, and go into the SRA 16? Actually, it might be a good chance to take questions on the 4 and 9.
Yeah, David, that's good. So I might just check in with the guys to see if we can reconvene or something. So is everyone happy to? So David, how long do you think for the SRA 16? probably another 15 minutes or so, would it?
Nearly 10. I think it would be under 10.
Under 10 minutes. So can I just check, Alistair and Tim and so on, are you happy to plough on?
Yeah, look, I've got about, it's Alistair here, about 10 more minutes and I have to go, so that's fine.
Yeah. Dominic? Okay, Tim's saying 10 minutes is fine, but that's all he has. Dominic, how are you travelling? I'd say it's probably okay. All right, David, well, yeah, you might just plough on through it to wrap it up.
Okay, right, sure.
Great.
Phil, can you mute yourself again? I could hear feedback before. Oh, that's all right. Okay. Okay. So the SRA 16 portfolio is a hedge fund. We consider it to be a platform for good ideas. We consider our multi-manager, multi-asset class skills also being brought to bear in the SRA 16. And the great advantage of the SRA 16, with it being a derivatives-based implementation, it allows extra strategies with very little crowding out. So the contrast is that if we were an equities manager with all our allocations having to add up to 100%, if we have a new idea, we can, so if we were equities managers, we would have to sell one stock to be able to buy another stock. With the implementation via derivatives-based strategies, we can continue to load up the portfolio with more and more ideas, and only very little crowding out of those ideas. So we're aiming for a risk target of 16%. That's obvious. That's in the name. We have a wide range of instruments used. There's a list that I'll show later on, mainly futures contracts. So it's a similar instrument universe to the commodity trading advisors AHL, Winton, OMIP, etc., and BlackRock Asset Allocation Alpha. It is a liquid fund, monthly redemptions with no lockup, that will soon be weekly, and plus 18% per annum total return since inception. That was an update of an old slide. Okay, so the way we typically explain what's in the SRA 16 is breaking it up into these components here, which each have a number of items in that category, which each have a volatility contribution. Now, bearing in mind that the volatility of the total fund is 16%, and the point being that we can add up all these volatility contributions and it adds up to much more than 16%. So that's the diversification benefit that you get from having multiple strategies in the one fund. And the expected return contribution before fees. So the quantitative market beta component, what that's trying to do is obtain risk premia. So we have a long bias to equities, a long bias to duration, a long bias to credit via the interest rate bank bill curve, and a long bias to commodities. We have structured basically a static allocation to these risk premia, which have a 6% volatility contribution, and from that we expect 3% per annum. The quantitative alphas, it's a bunch of ideas which are fundamental in nature, or there's a sound theoretical basis for these ideas, and which are supported by backtests. So these are typically categorized into three different types: trend following. So there's a component here which actually has a fairly high correlation to some of those managers I mentioned before, Winton, etc., and that's based on the same idea. There's valuation indicators, so particularly where we have a risk premium idea, we would up the allocation to that or downweight the allocation to that based on the valuation indicators that come through the quantitative alpha strategies. And there are some seasonal strategies in there as well. I'm sure you've probably heard in the last few days the sell in May and go away concept. We have a strategy which is based on that. But that's just an example of one of the several seasonal strategies that we have. Quantitative vetoes, this is only ever a subtraction from the quantitative strategies, and it's really just an attribution category. The point is that we consider quantitative strategies they work on average over the long term. Sorry, they work on average most of the time, and therein lies the problem. So we consider there to be times when the fundamental premise of what we're trying to obtain from these quantitative strategies is called into question. An example would be some of these seasonal strategies during the global financial crisis. Seasonal strategies, the premise is there are regular events in markets based on the behaviour of the participants in the markets, and we consider that the heightened volatility during the global financial crisis and the whole bunch of other reasons that were dominating markets movements at that time were overwhelming the reasons for these calendar-based strategies. So we have we just turn those off basically, and we consider the attribution to quantitative vetoes as a offsetting strategy to those quantitative strategies. The discretionary active positions, so this is strategies which are devised by Simon Kitson and Chris Howland, who make up our discretionary strategies team. They have fundamentally based ideas, and they have technical indicators which support their trading in and out around those core positions. So they'll typically have about 5 to 15 distinct strategies on at any one time. We expect the volatility contribution to be, actually the volatility should average 9% with a range of 6 to 12, and we expect 4% per annum from that. Because this is a derivatives-based portfolio, the way most derivatives-based funds are comprised on their balance sheet is an allocation of 100% to cash and allocation to contracts which add to or subtract from that cash on a daily basis. So we typically require about 20 to 30% of that cash in margin deposited in futures brokers accounts. And so that would mean there's typically 70 to 80% of lazy capital on the balance sheet of the fund. So we've looked at that and thought, well, we can do better than that. We have a process whereby we're picking managers all the time. So we've allocated around about 40 to 50% of the net asset value of the fund to those highest alpha managers that we've identified in the 4 and 9. So there's a bit of a doubling up of those allocations with respect to the 4 investing into the 16 and the 16 investing in common managers that are already invested in the 4. So we expect to outperform by about 4% from those managers. The risk component is similar to the quantitative vetoes in the sense that it only ever subtracts from the positions that we have on, so it reduces the size of the positions. An example of how this would occur is if there's a bunch of discretionary, if there's a bunch of quantitative strategies, the seasonal is kicking in say in respect of gold, the trend following is saying we want to go long gold, there's a valuation indicator saying we want to go long gold, and then also the discretionary team also wants to go long gold. So we have a limit in this example of gold of 50% of the portfolio. If we add up all those individual items, we might find that the total allocation would be 72%. And because that's in excess of the limit, we will pretend that each of these strategies above get their full allocation, but there's a minus 22 with respect to gold in the risk allocation. So it's just a way of constraining the portfolio to its sensible limits, but still pretending that the strategies get their full allocation. The list of futures markets that we trade is shown here. I won't go into that too much, but it's quite a lot. The number is more like 50 or 60. It's actually bloated by these 42 sector cap indices that futures contracts that we don't use very much. But most of the other futures contracts that we show here are in the quantitative strategies and typically have some allocation to them. The other instruments we use, the usage of options is typically fairly small. It's been mainly bought options and occasionally sold options, and since inception it's been sold options against existing bought futures positions. So there haven't been any naked sold options. We can actually have naked sold options in the IMA, but it's not going to be a feature of the portfolio construction. Certainly hasn't been in the past. Forward FX, as I said before, we're now able to transact in a much longer list of foreign currencies. And one day we'd like to have prime broker relationships with prime brokers, but that's probably in the future. And we invest in managed funds, which I've said before. The quantitative strategies, I think I've explained these before as I was going through the strategies, so I won't say any more on this slide. The discretionary strategies team declare the strength of their conviction as 1, 2, 3 or 4. So remember before that the total volatility of the SRA 16 is obviously 16%. The total volatility across all of their strategies of the discretionary strategies team should be an average of 9% and typically between 6 and 12 from time to time. So each of the strategies that they have, say they want to be long gold, they might give that a conviction of 4, which is about where it is right now. They want to be, they don't have a position on equities markets now, but typically they've been short the equities market since inception. So we don't say that we want to have a minus 15% in, say, the S&P 500. That's expressed in terms of volatility risk budget. So that would be a 2% volatility short position in the S&P 500. And that's what I'm trying to say here. So the strength of the conviction equals the volatility risk budget, which is effectively the SRA allocation. This what I call cascading series of limits to avoid concentrations of risks. I'd mentioned this before with regards to one example, the gold example, which was a limit with respect to each contract. So that was the total position in gold is limited to 50%. The total position by asset classes is also limited. In the case of commodities, it's limited to either 70 or 100%, 70%. And by source, so as I mentioned before, the total volatility risk budget for the discretionary strategies is 12. So they could be very bearish or very bullish at any given point in time, but they're still limited to a 12% volatility risk budget. As I gave with the gold example, the allocations are simply added up. We consider that to be robust construction, so it's not a black box optimizer. It's not dependent on correlation assumptions, which was some of the failures that some of the other black box optimizers and quant managers had during the global financial crisis. No crowding out. It's similar to the concept before about because it's derivatives based, we can keep on adding strategies. And in the way that I described on the previous page, the allocations to strategies and ideas are controlled by this idea of the cascading limit structure. The target portfolio volatility is 16%, but limited to a maximum of 22% at any given time. And the average, not the average, the maximum has been about 20% at any one time. I can set that lower if I believe that the volatility in the market is too high, which I did during the global financial crisis. The trader has very little discretion to deviate from the model portfolio, so we put this into the computer and it spits out a portfolio, compares that to what we have, and so the difference between the two is the trade list. And so the trader has very little discretion to deviate from the model portfolio. Examples of where they would deviate from the model portfolio is, say for example on Monday, the UK market and the Hong Kong market were closed for a holiday, but most of the other markets were open. So there'd be some sort of technical reasons for why you would not trade other parts of the portfolio to balance out the fact that you're not trading in Hong Kong and UK markets. The SRA 16 portfolio has been one of the highest returning funds in Australia since inception, which happened to be the top of the market, top of the equities market. It was the highest returning fund on Morningstar for 3 years to 31 December 2010 out of more than 10,000 funds on that database. The last 2 years have been a little bit more challenging for the fund, but it's still got an excellent Sharpe ratio of 0.72. The volatility has been a little bit higher than anticipated, so 19% instead of 16%, but that's we consider still in the ballpark and somewhat forgivable given the excess volatility of markets over that time. We expect the SRA 16 to have a volatility of the long-term equivalent to that of equities.